Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Farian. He's the CEO and founder of Flying V, our digital marketing partner. Rob, how are you doing and where are you traveling tomorrow?
I'm doing great, Gary. Thanks so much for having me. Our first show of the new year. So happy new year to everybody out there.
Happy New Year.
Tomorrow I'm traveling back east, Philadelphia. It's supposed to be cold and I guess potentially snow, which is really great for me being from California and that it's a last minute trip. So I have absolutely zero snow gear. So that should be really fun navigating that weather all next week. So, or this week actually. So yeah, I'll be flying out red-eye tomorrow.
All right.
And where
Well, what's that?
where are you?
I am in Chiang Mai, Thailand, where it's plenty warm.
Yeah, that sounds amazing.
Yeah,
The
it's
travel.
what's that?
How was the travel?
It's a long trip to get here. Took about 30 hours door to door, and it's a 12-hour time difference, so it took a little while to recover, but happy to be
Yeah,
here. And then I'll be here for another week, and then heading to Vietnam and Korea after that.
very good. Very good. Well, we've got a great edition of this week's Five Things, Gary. We're calling it the We Tempt Fate Again by disagreeing with Nassim Taleb on Bitcoin issue. Again, love those titles and very lengthy, but very descriptive. So we'll be talking about new white paper that's going out, going to be launching here shortly. We're talking hidden junk fees, mandated pricing, analysts about the S&P 500, retail sales again, and then we're looking at some bonds here for our fifth thing this week, Gary. Gary, anything you'd like to say? I believe we have Alex that's going to be moving on as well, DKI intern. We're going to miss him, but a great opportunity for him. And I think welcoming a new intern in to help support the version of the five things.
That's right. Alex is going to be moving on. He received a full-time offer to help build a new business with somebody in the Bitcoin and finance community who I know and respect a lot. It is a great position for him. Alex has been a fantastic contributor here at Deep Knowledge Investing. And sometimes people say to me, "Well, isn't it a problem that these guys move on?" And the answer is no. That is the purpose of an internship. It is not the purpose to set up a system where these young people work here forever in an internship. Every time they get a great offer to move on and do something bigger and better and get themselves paid, we applaud them. That means we've succeeded for that means we've done our part for them. We fulfilled our obligation to them. And so Alex moves on with our applause, our appreciation. He was a great contributor here. And I think he's going to be doing fantastic things in the future. And I know where he's going. He is nothing but our, applause and support. We are now joined by Josh Reeves from the same University of Tennessee program that Andrew Brown came from. Josh is brand new, but off to an excellent start. So we have high hopes for him. And as legendary football coach Bo Schembechler used to say, the expectation is not for the man, it's for the position. So, Josh, you are next man up and you're a starter now.
There we go. I like that. Well said, Gary. Thank you, Alex and Josh. Looking forward to working with you. Gary, let's jump right into it. Thing number one, we talked about it, the re-release, second edition of our Bitcoin white paper. Gary, I'm going to let you basically take this away, right? In terms of just announcing the white paper, what's in it, the difference between this version versus the last. But thing number one, Gary, announcing the second edition of our Bitcoin white paper. And then maybe I can wrap it up and let people know how they can get it.
Thanks, Rob. So, Nassim Taleb is somebody who I respect a lot. He's written some of the best books on financial risk control, like The Black Swan, Fooled by Randomness. I think he is a terrific writer and a terrific thinker. About 5 or 6 years ago, he wrote a white paper that was very supportive of Bitcoin, and I've read it. I thought it was excellent work. 3.5 years ago, he reversed his position. Now, he's entitled to do that. There is nothing wrong. In fact, in finance, it's very important to update your opinions, and if you're wrong, to change your mind. So he's entitled to do that. But 3.5 years ago, he wrote a white paper where he claimed that Bitcoin was worth zero. Now, I've gone through that white paper a bunch of times, and I don't agree with his conclusions. And in my opinion, some of the arguments that he makes doesn't reach the standard of the arguments that he suggests need to be fulfilled, or the standards rather that he laid out again in books like The Black Swan or Fooled by Randomness. 3 years ago, Deep Knowledge Investing put out a white paper basically critiquing Taleb's paper and saying, hey, we don't think your arguments are correct here. Now, in the last 3 years since we put that out, there's been a lot that's happened in the Bitcoin community. There's been, Operation Choke Point, where the US government tried to shut down and successfully did shut down crypto-based banks. China banned Bitcoin mining. Gary Gensler, the outgoing chairman of the SEC, ended up dragging his feet on Bitcoin ETF approvals and then eventually did approve them. And they turned out to be the biggest, fastest growing ETF launches in history. During that time, Bitcoin had a 75% drawdown, actually more than that, going from over 60,000 down to about 15,000. Here at Deep Knowledge Investing, we didn't panic. We just bought more when the price went down. And then came roaring back from about 15,000 to, Bitcoin as of this conversation is around 102, 100, 101, 102,000 US dollars. Now, it's very important to note that the dollar price of Bitcoin is not the scoreboard. Taleb did not say that there won't be irrational exuberance and that, the price of Bitcoin would go straight to zero. He's saying it eventually will go to zero. So the fact that Bitcoin has run up to 100,000 plus doesn't make him wrong. In my case, we put out that white paper and Bitcoin went from, I think it was 64,000 down to 15,000. I didn't think I was wrong. I didn't think the dollar price was a scoreboard. We just bought more, and that's fine. So, this is not one of those cases where we look at the price and say, see, we win, because those prices can change and they can change quickly. We're talking about the quality of arguments. But given everything that's happened in Bitcoin and all of the new holders and hodlers and ETF holders and pension funds buying Bitcoin, we thought it was a good time to update our analysis. What we did was we took our 3-year-old white paper critiquing Taleb's piece and we updated it. We added new facts, new figures, new pricing, and a lot of graphs. Our intern Andrew did a ton of graphs, so we thought it was important to add a lot of images to make it more approachable for people who aren't used to reading, lengthy, hard to digest white papers. We wanted it to be easier and approachable. And then Alex Petro, actually wrote a whole technical section on Bitcoin payments and the different payment levers and how Bitcoin is being used for actual commerce. And in fact, Rob, I can tell you, I was out to dinner 2 nights ago here in Chiang Mai, Thailand, and the restaurant that I went to, they had it prominently on the sign, we accept Bitcoin. So I could have paid for my Thai red curry using Bitcoin. Um, again, this is not, we are not picking at Nassim Taleb. He's somebody I respect. I like his work a lot. I just disagree with him on this point. But the new and improved white paper will be made available. We believe we're going to have it out on Twitter or X Wednesday morning, New York Times. So, take a look at my account. It's at Gary_Brode, Brode. It'll be the pinned post. And, if you interact with that post, we'll have something, you'll be able to put in Bitcoin or something like that, and we will automatically email you a link so that you can download the white paper.
Yeah, and we'll have plenty other ways you can get the white paper. We'll be sending that out via email. So be sure to at least put your email in for our free subscriber list. And then we'll show you how you can get your copy of the new white paper that will come out Wednesday morning, New York time. Gary, what? Probably 10 a.m. New York time, more than likely. 9,
That's
9 o'clock, 10 o'clock. We'll keep you updated on that.
Yeah, that's what we're aiming
Yeah,
for.
as Gary mentioned, it's a great piece. Think it really helps you to understand the entire picture, regardless of intermediate, advanced level of investing and understanding. Just does a really good job of having something in there for everybody. Gary, we're going to move on to thing number two. We're talking junk fees, mandated pricing. Thing number two, Gary, hidden junk fees versus mandated pricing.
So, Rob, you know deep knowledge investing's opinion, in my opinion, of governmental overreach and excessive regulation. But we are going to break form here and actually applaud the current White House, the outgoing administration, on a new regulatory rule they put in place. I know this is, unusual for us to be saying, hey, more regulation, we're in favor of it. But I think the existing administration made a great point on these junk fees or resort fees. And what we're talking about here are situations where people book a hotel and they get there and they get the bill as they're checking out and they find out all of a sudden that they have hundreds of dollars of these junk fees. A lot of times they're termed resort fees. They'll be for things like Wi-Fi or the hotel gym. And they are mandatory. They're often not waivable. They are often poorly disclosed. And, we've just heard situations, and I've seen situations where I've gone somewhere and all of a sudden the bill is hundreds of dollars of higher. And they're saying, well, it's for Wi-Fi. So I have a data plan on my cell phone. I don't need your Wi-Fi. What was for the gym? I didn't use the gym. I didn't ask for the gym. Um, this basically is a way, Rob, for companies to advertise a very low price so that they get picked in in things like Travelocity or a hotel app, hotels.com, Google Flights or Google Hotels, Google Travel. They try to get themselves picked with low prices, but that doesn't mean you as the consumer are going to be paying low prices. And I actually think it's the right thing to do because people were saying, hey, listen, you can charge what you want, but you need to disclose this. And I think it's important for two reasons. One, people were being surprised, and I don't mean being surprised by a little. They were getting hotel bills that surprised them by hundreds of dollars. Same thing also, you would go to book airfare. And by the time you were done with your check-in fee and your seat fee and checking a bag and, ancillary fees, I had a situation where I was booking for this trip, Rob, where some of my flights ended up costing me twice as much as the rate that was shown on the website that I was using. So my actual price was double what I ended up paying. I sorry, what was advertised to me. Now, part of the problem is it's costing people a lot more money, but beyond that, it's taking people hundreds and hundreds of extra hours because instead of saying, okay, my rate is $200 for this airfare or $75 a night for the hotel or whatever it is, um, you go to book it and then you find out, oh no, it's so much more. And so then you have to go book again and you spend hours looking through the fine print and you're scrolling through, just you're looking through all the fine print at the bottom looking for where the stuff is disclosed. And it's taking people just dozens and dozens of extra hours to book a trip because they can't figure out what anything costs. The White House is saying enough. Give people a final fee and advertise yourself based on what your customer is going to pay. And I think that's a good idea.
Now, Gary, how would this relate to talking about the junk fees versus what you'd call mandated pricing?
So I think that's the key question, Rob. One of the things that we've been very much against is mandated pricing. Candidate Kamala Harris was talking about fixing food prices. We said that's going to lead to food shortages. President-elect Donald Trump was talking about limiting things like overdraft fees or how much banks could charge people. We said it's a bad idea. These people are going to be debanked. The difference is the current regulations from the current White House are not suggesting that the airlines can't charge whatever they want, that the hotels can't charge whatever they want, that the rental car companies, they can all charge what they want. They're not trying to control pricing. What they're saying is you have to disclose your pricing. And so here's where deep knowledge investing comes out on that. If the government wants to try to control pricing for people and tell companies what they can and can't charge, we think that's a bad idea. That will lead to shortages and higher prices overall. If, on the other hand, the government wants to say you can charge what you want, but you have to disclose it clearly to your customers so that they're not surprised later or don't have to waste dozens of hours looking for, reading through everybody's fine print and trying to make sense of it all. then what they're saying is charge what you want, but you have to provide your customer clarity. And I think that is a completely valid way of doing business. I think in a capitalist system, it's okay to charge what you want. We support that. But misleading people, that is not okay. And so this is one of those situations where the current administration, in my opinion, got this one right. And I'm looking forward to seeing those new regulations go into effect. And our warning for both the outgoing and the incoming administrations is do not try to force companies to don't try to set pricing for these companies. Let them set their own pricing and let them disclose it.
Yeah, let the market decide. Gary, thing number three, we're talking S&P 500 earnings. Lots missing the mark. Thing number three, analysts missed the mark on 22, 23, and 24 now S&P 500 earnings, Gary.
Well, Rob, you know, for years it has been a point of pride and sport around deep knowledge investing to poke at the sell side, which is really more advertising and less research. Um, Back in late 2021, we put out a white paper for people warning that inflation was not transitory and was going to be huge and a gigantic problem. And we told people what to do. In 2021, we told people to buy energy, gold, Bitcoin. Hey, that worked out really well. Um, and at the beginning of 22, we said to people, the Fed is going to hike rates. That's going to take the market down and it's going to reduce company earnings. The company earnings estimates are 100% wrong. Now, at the time, I'm checking the chart here, the estimate for 2022 for S&P 500 earnings was around $230. That ended up going down below $220. We were right about that. The 2023 estimate at the time was over $250. And that came down. At the time we were talking about it, the estimate fell to 230. But if I check a later dated chart, the final 23 number came in right around 220. So I think we had 2022 starting around 230, and it came down to about 218. That's a big drop. The 23 number started around 251, 252, and that ended up around 220. So why am I pointing all this out? Well, the reason is if we look at the 2024 estimates, those started around 275 and are now down to just above 240. By the way, I want to thank Dr. Ed Yardeni from Yardeni Research, who generously allowed us to use one of his graphs showing this. If you look at the written version of the five things, you'll see the Yardeni graph. It is excellent work. So Dr. Ed, thank you so much. Really appreciate you. That is Yardeni Research for anyone who wants to take a look. But the 2024 estimate has come down from about 275 to right now it's just above 240. Now, why does that matter, Rob? It matters because the 24 estimate is now below where the 23 estimate was 2 years ago, and the market has done nothing but go straight up. So we have a situation where the analysts keep saying earnings are going to be great, and then they're wrong, and the earnings keep coming down. And we are now at a point where the earnings are more than a year behind where they were a couple of years ago, and the market has gone straight up. And if that doesn't concern you, I don't know what would.
And Gary, on that point, I mean, what did you see? What did DKI see that others didn't? And what have you guys done to obviously position your portfolio for a situation like this?
So we saw a couple of things, Rob. One is generally higher interest rates will slow the economy. We correctly did call a recession in 2022. A lot of people say we didn't have a recession. That's nonsense. We had 2 quarters of negative GDP growth. The truth is, our private market, our productive private market economy right now is in a recession. The only reason we are not officially in a recession right now is because our government is overspending by trillions of dollars. That adds to GDP, whether it adds value or not. So, what we've done is loaded up with, again, things that do very well in an inflationary environment. We own a lot of gold. We own enormous amounts of Bitcoin. We've owned a lot of energy. And then I found high growth stocks to invest in, and we've hedged out the market exposure. Now, there have been times that hedge has been profitable, and other times it hasn't done so well. But as long as our individual stock picks outperform the market, which they have, it's turned into a much lower risk but very profitable trade for us. So these are the kinds of things that we've been able to do to help deep knowledge investing subscribers navigate through a really difficult and confusing market.
Great stuff there, Gary. Moving to thing number four, we're talking retail sales. If you've been tracking along, we've been talking about this a lot over the past couple of months. But what we actually saw was those trending up. Thing number four, Gary, holiday retail sales up, fueled by discounts and wealthy shoppers. The rich get richer.
Yeah, there you go. So, over the last couple of months, we have done a ton of coverage on this channel of weak retail sales, and we've talked about how money is shifting from full-priced retail to the discounters, how purchases are shifting from discretionary to necessities. We've talked about that a lot. And because of that, a lot of people expected our Christmas shopping season to be very weak. In addition to that, because the shopping season goes typically from Thanksgiving to Christmas, but the number of days in that period are not the same every year. This year's holiday season was 5 days shorter than last year. And with five fewer days to shop, we figured, hey, we're going to have, weaker than expected sales. Turns out that was not the case. Total spending for the holiday shopping period was up 3.8% this year versus 2023, with online spending contributing 6.7% growth. And so sales crushed forecasts. So the forecast was 3.2%, and last year's number was 3.1. So these were terrific numbers. And so the question is, what happened here? Well, it turns out that it was the usual culprits. It was discounters like Target, Walmart, Dollar General. They focused on discounts. They cut prices to push sales. So, listen, if you cut prices enough, people will buy. The other
Gary, how much of this has to do with affluent households and their spending? As we obviously know, in an inflationary economy, tends to be a good thing for wealthy households.
So, Rob, it was a combination. At the low end, the lower income consumer benefited from discounts at places like Walmart and Dollar General. They took advantage of these companies cutting prices. But the big spending increases came from the wealthier families. We're showing high income families spending more than almost 17% more. Um, and the reason for that is because we've had an asset bubble. Pardon me. The rising stock market and rising home prices have been great for people who had money. And also, hard assets like real estate and gold and Bitcoin, those things have done really well. And so we've had an economy where most of the country is not doing so great, but the wealthy have been well positioned for this. And so they spent a lot in throughout the Christmas season.
Gary, University of Michigan as well. They did a consumer sentiment survey. One of the things that they highlighted was low to middle income individuals don't feel like they're thriving, right? While you're seeing the inverse. Tell us a little bit more about that study, and I think a few other key points in the news just about the real bifurcation you're seeing in what's happening with this spending.
Well, I'm thrilled to see people starting to talk about this because, Rob, at Deep Knowledge Investing, we started talking about a bifurcation in the economy 2 years ago. And what we noticed was that the low interest rates, high real estate prices, high prices for hard assets, a rising stock market, those are great for wealthy people. A lot of times, what people like to say, what the government will tell you is, well, things are rough for poor people, so we're going to print a lot of money and have all kinds of programs to help poor people. And it sounds really good. But what ends up happening is those programs end up creating inflation. And wealthy families who have credit scores that start with an eight are able to take on debt, and that debt they can repay in dollars that are worth a whole lot less later. and buy hard assets and buy stocks. And that works really well for them. Poor families are crushed by inflation. And so all of these programs that the government says we're going to do this to help poor people, they end up hurting poor people. And we've talked about this before a couple of years ago when the government sent out those stimmy checks. People said, "Oh wow, $1,600 of free money from the government. This is terrific." Yeah, you got $1,600 once, and people's expenses went up by $100 or $200 a month. And so, yeah, you get $1,600 once, but it may be costing you $2,000 a year in perpetuity with a higher price index. These programs never do what they're supposed to do. Um, these programs end up creating inflation that works really well for wealthy people, poorly for poor people. It is misleading, and as a result of this, we've been talking for 2 years about a bifurcation of the economy where most of the country is struggling to pay for things like food and rent, their car, to put gas in the car, to heat their home. And the wealthy have just done extremely well with the rising price of assets. And so, we saw that in our holiday retail sales, and we're starting to see that in studies coming out. This is not a surprise to us, but we're really glad to see that people are starting to realize, oh, wait, this is a problem.
Gary, wrapping up this week's version of the five things, we're going to talk a little bit about bonds in our investor education portion of the five things. Gary, thing number five, breaking down bonds, the yield price relationship explained. Gary, tell us more about bonds and yield price.
So, Rob, the issue here isn't that there's anything wrong. It's that the terminology that people use to talk about bonds is often inaccurate or misleading. We just sort of talk about things in a way that makes sense to us. And, people don't say exactly what they mean, but we know what they mean. So let me explain. The price of a bond and the yield of a bond are inverse to each other. So let's imagine that the you have a bond it's $1,000 bond, and let's say you have a $50 coupon on that, and so what you have is a 5% yield, right? 50 divided by 1,000 is 5%. Now, if the price of that bond falls, say it falls to, $500, and this is back of the envelope math, the bond math people, I know it's more complicated than this. We're just using a simple example for people.
Keep going, Gary.
Yeah, you can put it in the comments that this isn't exactly right. I know, just we're trying to simplify things. But let's say the price of that bond gets cut in half. It goes from $1,000 to $500. Well, your coupon is still $50, so your yield is 10%. Okay, so if the price of the bond falls, your yield goes up. If the price of the bond rises, the yield goes down. And the reason that matters is because we were talking about the Federal Reserve in September, in my opinion, unwisely cut the Fed funds rate. And ostensibly, the reason they said they were going to do it was to bring down borrowing costs for people. Well, the yield on the 10-year Treasury rose from 3.6% to 4.6%. It's the exact opposite of what the Fed wanted. Now, the reason that happened is because the bond market was saying, wait a minute, the Fed is lowering rates. We're going to have more inflation. They priced in higher future inflation and said, that's risky. We want a higher yield. And so the price of the 10-year bond came down, increasing the yield from 3.6% to 4.6%. Now, what we've heard people saying a lot is people are often saying right now, well, the 10-year is up. Now, is that correct? No, it's not. What they mean is that the yield on the 10-year is up. This is a situation where the language of finance is imprecise. So if I'm talking to, one of my friends, a fellow hedge fund manager who says, yeah, the 10 years up from 3.6 to 4.6, I know what he means. I know he means that the yield is up. But it can be confusing for people because the 10-year is not up. The price of that bond is down, the yield is up. And so what we want to do is explain to people that this is a situation where the vernacular, the common language of finance is just often inaccurate and imprecise. And if you talk to people all day, every day, you know what they mean. But when you hear people saying The 10-year is up. It is not. It's the yield that's up. The price is down.
Any additional questions for Gary? Leave those in the comments. Any clarification that you may need, or getting on him and letting know that your calculations aren't precise, Gary. So
Yeah.
I'll clean that up for future versions.
Yeah, we're not doing an hour-long bond math seminar here. Sometimes it's just good to give people the back of the envelope and help people understand in simple, clear terms what's happening. We're not trying to help an audience of non-professional investors price bonds. What we're trying to do is help you understand what people mean when they talk about it so that you can follow the conversation because these things are important. I do think we're going to see increasing bond yields over the next few years with higher inflation. The Fed does not have great control over this right now or any control at the moment. So these are issues that you're going to hear people talking about over the next couple few years. And it's just good to understand the language surrounding it. And that's where we're trying to help.
Great stuff, Gary. And that concludes this week's version of the five things. As we mentioned, be sure to put your email on our subscriber list. We got our white paper coming out Wednesday of this week, so be on the lookout for that. You'll get notified via email if you're on our list to get that download opportunity. This concludes the We Tempt Fate again by disagreeing with Nassim Taleb on Bitcoin issue. Wow, Gary, I need a raise. And that is a mouthful, but be on the lookout for that white paper. Gary, I'll give you the last words of this week's version of the five things.
Thanks so much, Rob. And by the way, everyone, the reason, we phrase it as we tempt fate is because, Taleb's a difficult guy to disagree with. He's a very smart person. He's well researched, phenomenal background in math. Like I said, I don't have a problem with him. I just think he's wrong on Bitcoin. But one of the things that we do in the paper is we provide a link to Taleb's work. And so what I would advise everybody to do is read his piece, read our piece, and then decide for yourself who has the better end of the argument. Either way, download it, check it out. We're making it available for free because we do want people to understand Bitcoin and the arguments around it. These are going to be important issues in the coming years. For everyone else, again, Happy New Year. Happy to be coming to you from Chiang Mai, Thailand. And, just know again, as always, your time is valuable and we appreciate you spending it with us. If you want to like and subscribe, terrific. We'd love to have you. If not, hey, we're not the boss of you. Do whatever you want. Great to see you. And we will be here with more great content next week. Thanks.
Thanks, everyone.